Well, good afternoon, traders. Chris Weston here, Head of Research at Pepperstone. One of the things we're talking quite actively with clients at the moment is about this readjustment we've seen in financial markets, but the conflicting messages we're seeing going through different asset classes and different products at the moment, and actually which one is correct and perhaps which one needs to change. And if I actually look at the heart of what we've seen really from the beginning of the year, in probably mid-December, we've seen a very, very aggressive response from central banks. Now, okay, granted, we've seen a better feel towards Brexit of late, we've seen a better feel towards what's happening between the US-China relations, but ultimately central banks have really come to town here. We've seen the global money supply up about 5% since November. The Chinese have obviously been very much at the heart of that situation. We've seen M2 money supply increasing recently up to 8.4%. New yuan loans have been going up to a record level, obviously as a response to what we saw earlier in the year with the triple R or the reserve ratio requirement cut by 100 basis points, and the banks allowed to go out and extend credit to a much more aggressive dynamic there. And people are speculating that perhaps the worst is behind us, that perhaps the credit impulse change that we've seen there is going to see a change and a low in Chinese economics, which should be good for Europe and it should be good for US growth going longer term. But certainly we've seen that situation. The Fed have obviously been very much at the heart of this as well. We've seen a robust discussion from the Federal Reserve about their balance sheet, and it's now almost consensus that probably by the May meeting we'll have a formal announcement around the terminal size of their balance sheet, which should see an early end to quantitative tightening or their balance sheet normalisation program by the end of the year. We could also add in other issues that we've seen from various central bankers within the Fed who have detailed the range of policy responses they can have should we see recessionary environments coming through in later periods. People have been talking there on the Fed about negative interest rates, potentially adopting quantitative easing again as a policy tool. They've talked about inflation targeting and average inflation targeting specifically there. They've also talked about going down a similar path as what the Bank of Japan have done, which is capping parts of the yield curve, or what they can consider to be yield curve control. But there has been a range of outcomes there which we've seen from the central bank. Here in Australia, of course, the RBA have moved to a more neutral setting. The rates market, or the swaps market, should I say, has got a full rate cut being priced in over the next 12 months. We've also heard from the ECB, and it's almost consensus now that we will see a formal announcement of a new round of cheap liquidity to the European banking sector when we see that ECB meeting coming through on the 7th of March. Of course, the RBNZ have come out recently with changes or a slightly less aggressive or hawkish tone to their statement as well. And I could go on, but the fact is that central banks have worked in a cohesive manner. What has that done? It's suppressed volatility. We can see the VIX down at 14%. In FX markets, as all central bank policy is pretty much going in a similar direction, we've seen a situation where implied volatility in FX markets has been shot to pieces. You can see that in the various measurements, but implied vol has really been shot, and that's allowed traders to go and get paid to be in position. They want to be in carry positions, buy the highest yielding assets they possibly can, and funding that with the yen and also with some very, very lower yielding markets there as well. If we have a look at this change in markets more broadly with this huge expansion of money supply since November, we can see copper prices moving up to $3 or near $3 per pound, about 16% in this move. We've seen oil prices moving up 33% since the last year's lows. And that's obviously been in response to what we've been seeing from Saudi Arabia and, of course, the more broader OPEC region and the cartel there themselves. And that's allowed five-year inflation expectations in the US to move up from 1.77% to just over 2%. And what that's ultimately mean when we see break-evens and inflation expectations staying fairly firm while nominal bond yields have moved lower around the world, we actually have been seeing real yield or inflation-adjusted bond yields moving down very, very, very aggressively. That's very good for equity markets around the world. When we see the future cash flows, if we discount those future cash flows using the inflation-adjusted bond yield as a discounting mechanism, those cash flows are becoming relatively more attractive on a comparative basis every single day. And of course, that's allowed the equity markets to rejoice. The S&P has pushed up to 2,800. We've seen the ASX itself moving up to 6,200. And we've seen the price earnings multiple very much in the Australian market going up from about 13.5 times forward to around 15.5 times. So it's all been very much driven by price. There hasn't been earnings expansion through this situation. But where we are at the moment is we've seen these markets really reacting very aggressively to this situation. What I am quite concerned about, and the other message that we're seeing coming through in the rates market in the US, is a situation where no rates are being priced in for this year. Obviously, that's a reflection of everything we've heard from global central banks. But if we go into 2020, they're pricing in nearly or about 18 basis points of cuts. So the market's saying next year they're going to have to respond by easing rates. Is that going to be in response to a global recession? Or perhaps, but the message is quite dour that we're seeing from there. If I have a look at 3-month, 10-year yield curve as well in the US, we can see that that hasn't really steepened too much. Okay, 530s have steepened quite aggressively, but if we have a look at bond markets, they've not really bought into this idea that the central bank policy changes are going to create longer term inflation expectations. In fact, it's more a reflection of fighting fires. Something needs to change. Something needs to change fairly quickly, and I think we're going to need to see economics stabilise and respond much more aggressively to justify where these markets are at the moment. So certainly one to watch.